All right, welcome to a Larson Life Group call. I'm so excited to introduce my friend, Michele Baldwin, who should not be a stranger to any one of you. She is one of the key leaders on our team. She is going to be one of the new agency owners in 2025. We're excited for that journey that she's running on. But for the sake of this call, a lot of you might know her as kind of I've unofficially dubbed her the team mom too. I hope you don't mind that, but that's that's so much the role you play for so many of us, myself included. Um, but for the sake of our call tonight, Michele, I want to talk about advanced markets. So Michele is our subject matter expert, and one of them. We've got Kelly Bush, Joe Anderson does IULs. We've got several people learning advanced markets, but
Mhm.
Michele right now is set up in our system to take our FIF resets, our financial information form resets, meaning there are some clients you're going to come across that have extra money laying around and they don't know what to do with that money. We can help them with our advanced markets. And so there's tons of calls on how to uncover this with clients and then how to set them up to meet with Michele so she can help them and you get to split commission on anything she sells them just for your referral. So we've got this whole system set up and we've got tons of trainings on how to set them up and what to listen for. We don't have a lot of training showing you behind the scenes in exactly what these advanced market policies do for clients. And so I wanted to introduce Michele as our subject matter expert so that she can share her screen and walk us through some illustrations on what this actually looks like for the client in real life. So, hi, Michele. Welcome.
Hi there. Hi there. Well, I am super honored to be here. Yes, I'm team mom. I've been a mom longer than I've done anything else in my life. So it just kind of goes along with it. And it's just my honor to be part of the Larson Agency and Director Jim Larson, and to be here and share this with you guys. I'm super excited about it. Jim teases about the math nerds. I'm totally a math nerd. I love getting into the minutia detail and helping clients understand transactions they don't understand a little bit. So Jim and I are going to do a little role play, right? Can you see my screen?
Yep.
Is it actually sharing?
Yep.
Yeah,
We
you can
got
see
it.
where it says the fidelity and guarantee.
Yep.
Fantastic. Okay. So Jim is my 30-year-old married father of two. We kind of, made him a little younger for the purposes of tonight's role play.
Do
Jim,
my knees work well?
yeah, your knees are great, buddy. You're great.
Yeah, say that alone. I'm way in on this role play, just having working knees again. That sounds awesome.
Sounds like too much pickleball.
Yeah, it's way too much pickleball, but I can't not do it.
Well, fortunately, there's always knee replacement if needed.
Yeah. Yay. All right,
Um,
let's go to being 30. I'm 30.
you're
My
30.
kids are young.
You got young kids, you've got a great job, you're making $100,000 a year. So, financially, you're making good money. But like a lot of America, your company doesn't give you any sort of a retirement plan. That's because you make great money. A lot of times companies, it's a toss up, but there's a lot of folks we talk to nowadays. The economy, the world has changed. It's gone from the days of having pensions, then we had 401ks, and even now some companies don't offer any of that. So Jim's one of those guys. Doesn't have a 401k, but he's recognizing he needs some retirement. We had a call a couple days ago and got some like base information. This is going to be what we call our presentation call. So advanced market calls, and those of you that have done resets with me or have done your own, no, they're never a one-time call. The initial call is a discovery call, and I just ask lots of questions. You guys do a good job, and you ask questions, and you get an idea of what you think the client's going to be looking for or would be a good fit for. I'm going to go in and ask a lot more questions because just like life insurance, I need to know what do they need? What is their problem we're going to solve for? So in this first scenario, Jim needs some money in retirement. Okay, ready? Hey,
Yeah,
Jim, how are you?
doing great.
Good,
My
good. Are
knees
you?
are awesome. I played pickleball for hours and I'm not limping out of the car to walk home and stumble through my garage. So I'm doing
Yeah, no
great.
ibuprofen for you.
What's
I
that?
was going to send you some. I was going to send you some ibuprofen for Christmas.
Well, I'm 30 and I don't need it. My knees work great.
Awesome, awesome, cool. Well, hey, I wanted to get back together with you, kind of follow up on our call from the other day. I want to make sure that we're heading in the right direction here. Okay, so let me
Yep.
ask you a couple just questions. When we spoke the other day, you'd said that your biggest concern was having additional retirement, having or having enough income during retirement. Does that sound right?
Yes.
Okay, because
I
your current
don't want
job
to
doesn't.
work forever.
Yeah, that's probably not a that's probably a good idea. Don't work forever. And your current job, which you plan on staying at, but it doesn't provide a pension, it doesn't provide a 401k at this point, right?
Nope.
Okay. Are you expecting to get Social Security when the time comes?
If it's still there,
Did you know the Social Security page actually says, like, if you log on to Social Security, that they're expecting by 2035, they're only going to be able to pay 75% of scheduled benefits?
yeah, it doesn't surprise me.
Kind of scary, huh?
Yep.
So that little bit of money you were going to get is shrinking all the time. Okay. So besides Social Security, do you have any other money tucked away? Any rich uncles or
I
retire or inheritance you're expecting? Anything like that?
I don't have an inheritance. I don't have any rich uncles.
Okay. Okay. Well, so then it probably sounds like you're going to have to do some retirement account building on your own.
Yeah,
Yep. All right. Well, the good news is I have a really great option for you. Have you ever heard of an IUL or an Index Universal Life Policy?
I have.
Okay. So what do you know about it?
Well, I know that it's on TikTok. They tell me all about being your own bank and using this for cash value, and you can borrow interest free. And there's just, it's a way to, kind of be your own bank and have money that's protected.
Okay. It does build cash value. Um, I don't know that you borrow interest free, but that's okay. It does deal that. It does build a cash value, and that it is really good at that. And you can borrow from it. That's one of the perks we're going to talk about. So basically, the IUL, Index Universal Life. So it's a universal life fund tied to an index, a market index. So like the most common one is S&P 500. Every night on the nightly news, they talk about the Dow Jones and the S&P 500. The index is a picture of how the market's performing. So with the IUL, it's basically this life insurance policy that the IRS has made provision and says you could overfund it. So you can put more money in that policy than the cost of the insurance. So being it tied to an insurance policy gives you specific tax benefits and tax perks that you wouldn't get otherwise with a different type of investment. So let's say your insurance is $100 a month, you put in $200 a month, $100 is going towards that cash accumulation every month. Make sense?
Yep.
So the cool thing is you're putting that extra money in, getting those IRS tax benefits. It's going to grow like market type growth. So it's going to have really solid growth as the S&P goes up, you're going to go up. The other cool thing is though, if the S&P goes down, you don't go down. That's one of the benefits of it being tied to the index, not in the index. If your money were in a 401k, your money's most likely vested in a mutual fund, which is money in the market. So if the mutual fund value goes down, the stock price goes down, then your account value goes down. I'm sure you've seen that, heard that, right?
Yep.
When your money is tied to an index, you never do the decline. You participate in the growth and not the decline. That is contractually guaranteed as part of the policy,
Okay.
right? So it's kind of nice you get the upswing, but you never have to worry about the decline.
Okay.
Sound good? Um, the other thing is when you get ready to retire, you can take money out of the account or even earlier if you needed to. You mentioned, that you'd heard on TikTok, people can use this as their own family bank. If you're allowed to, after year one, take up to 90% of your account value as a loan. Loans are never taxed. So any money that you take out of this policy is tax free. Now imagine you just let this thing sit and grow and you don't touch it till it comes to be retirement income. Now, when you're taking that money out of retirement income, instead of paying 20% or 22% or whatever your tax rate is at that point to the IRS, you get to keep all of that for yourself because you're not going to pay taxes on it. Who knows? Maybe someday the IRS will tax loans, but today they're not taxing loans. So that's additional perk. The other perk is as you take money out of the account value, you're getting this index credit. As the S&P, as the index goes up, you get a percentage of credit to your index. Well, they don't recognize the loan. So let's say you had $500,000 in your account. You take out 50,000. You're still going to get your index credit on the full $500,000. So as you're taking money out of it, you're still earning money on the money you've taken out. It's kind of like a double win there. The benefit of that is it helps your account to last longer, helps your money to last longer. On a 401k account, when you start taking those withdrawals, the money's taken out and taxed. And then once the money is taken out and gone, it's gone. So if you've saved a whole lot, $300,000 sounds like a lot of money. But if you're pulling out $50,000 a year, that's going to last you 6 years. Whereas with the IUL, you're still continuing to earn the index credit on that full account value without recognition of the loan. Does that make sense?
Yep.
Cool. Let's take a look. One thing I want to show you real quick before we get into the actual fun math, I want you to see this. This is just historical performance. Now we're actually looking at this Morgan Stanley index because it's performing a little better than S&P. This is a guidance we get from advanced markets. So this shows you, I just want you to see this because it's going to be important when I show you the illustration. If your funds were invested in the Morgan Stanley index, just in the market, historically over the last 20 years, this is how that index has performed year over year. Now it's had some good years and it's had some bad years. Markets go up and down. That's what they do. On an average, just a mathematical average, if you look down here on the bottom, it's grown about 7.33% year over year. Not bad, right? We'll take 7.3. But if your money had been in an IUL this entire 20 years and had been in this strategy of the IUL, these are different strategies, these different columns. If it was in this, means you're going to get 100% participation of the growth. So as the index grew 10.63, you grew 10.63. But notice here in 2008, you didn't have the 19.39% decline. Not only did you not lose almost 20% of your account value, you also didn't lose time because it takes time to get back up and recover from that. So that means that this strategy had a 3% greater mathematical average increase year over year. So instead of growing at 7.3%, you grew at 10.3. Over time and over value, that makes a big difference.
Yep.
So keep that 10.3% in mind. This is kind of what your account could look like if you did this. So we had talked about a $400 a month contribution. You felt like that was a comfortable number for you, that you could put that into this account. And as you start putting that into this account, it's $4,800 a year. To 3 different looks at it. These first 2 we're not really going to look at. This is guaranteed assumptions. If the market tanks and has 0 growth year over year over year, we all have much bigger issues. We're all eating cat food, but you'd get nothing, and they're required to show you this guaranteed assumptions. That's the only thing they can guarantee is no growth. It does show like this 0.25 because that is the minimum, but it's very small. The middle one shows a growth of 4.5% year over year. Remember, 10.33 is what it's done historically. So this is very, very conservative. We're going to kind of park over here on this right-hand side. Still very conservative. It's showing a 6.2% growth, and historically we've done 10.3. This is still very conservative. But if we did that, you'll see there's account value, surrender value, net death benefit. Net death benefit is your face amount, your base amount, plus your account value. If you passed away in year 1, your family's going to get about $122,813. So as we go, you're putting $4,800 a year in it. Let's look at 10 years. You put in $48,000. You're paying for the cost of that $118,000 life insurance. And now you're sitting on an account value of $56,078.
Okay.
On a conservative view, right? 10 years from now.
So already by 10 years, I'm sitting on more cash than I've put in, plus I paid for life insurance.
Exactly. Yeah, exactly.
Okay.
And it's life insurance that has some living benefits. You've heard about those, the chronic illness, the terminal illness. Like if something happened to you, you could access the funds too.
Okay.
But what does it look like? Because you're only 30 years old. You got a ways to go to retirement, buddy. So at 65, you've worked hard, you've paid into this all these years. What does it look like at 65? So at 65 years old, you're getting ready to retire. Now you're sitting on a nice little nest egg of about $607,000. And
Okay.
you've put in 168,000.
Okay.
And you still have that nice base amount of your policy, 118. Plus, if you died the day after you retired, they'd get your full account value of $740,000.
Okay.
Total would be the account value plus the death benefit. Make sense?
Yep.
So based on whatever your account value is at that time, then you could start taking out that loan. I mean, you could take money out of the account anytime prior to this, but let's just say you were diligent and you were disciplined and you used it just for retirement. You built this up and put a cocoon around it like you would a 401k or something. You've got 607,000. That would work out to about $62,000 a year of retirement income, tax free. If this were a 401k, an automatic 20% off the top, whatever your tax bracket would be at retirement. That makes a pretty significant difference at 62. Would that make a difference for your retirement life at that point, that extra 62,000 a year?
Well, for sure, having that money, but I think even cooler than just having 62,000 is the fact that that's not taxed.
And that is the power of the IUL. That plus the fact that here you'll see, now your account value is not ever going to decline, but look at the surrender value. In this first year, the surrender value is a little less because that's where it shows that money coming out. But it's not a full $62,000 less because you're still getting paid your index credit on the full account value.
It's still earning interest.
You're earning the index credit on that $62,000. So if it was a 10%, you're earning an extra $6,000 on the money you took out on top of the rest of the account value.
Because that wasn't what I'm due essentially at 66. I'm not withdrawing my from my account. I'm borrowing against it.
Exactly.
Okay.
Exactly. And the loan never has to be repaid. So because your death benefit is the collateral per se, and they only allow you to borrow up to 90% of your account value, the insurance company is going to get their money back, right?
Right. So if I die with an outstanding loan, the insurance company will pay back the loan from my death benefit first, and my family will get what remains instead
Exactly.
of the full death benefit.
Exactly. Yes.
Okay.
Yeah, exactly.
So
So you're borrowing money.
assuming I live to 85, let just roll down for me.
Yeah.
At age 85, I'm still getting $62,000 a year. My account's still grown.
Yep. Yep. And if you waited it for some, and notice, right, the payments stopped at 65.
Yeah.
If you're going to start drawing on your retirement, you're probably not going to be even paying into it. This is, and just so you know, this is an illustration. This is what it could look like if you did this.
Yeah.
You could stop these payments sooner. You could continue them on. You love your job. You don't want to retire at 65. You're going to work till you're 70. Look at 70,000. At 70, you're sitting on 861,000. That's going to affect how much you can take out of the account every year.
So let me ask you this. This is not even a Jeff question. This is a Jim Larson question. I'm
Okay.
looking at 85 years old and I'm seeing a value of like $2.3 million, but only a death benefit of like 200 something dollars. What is the difference there? Why is my account value so high, but my death benefit so low?
The account value is what you're going to earn your index credit on. The death benefit is low because of all the loans you've taken out.
Got you. Okay. So as I'm borrowing money, my principal's kind of remaining the same, but the death benefit's low for the reason it is paying that back first.
Mm-hmm.
If
Exactly.
I hadn't touched any of this money at all,
Hmm.
and still stopped paying at 65, but I didn't borrow against it at all. Let's say I
Hmm.
did have a rich uncle I didn't know about. So I
Yeah.
stopped paying at 65. Now I don't need to touch this money. You're telling me at 85, I might be leaving my family $2.5 million.
And did you want to adopt me? Yes, that's what I'm telling you.
Wow.
Hmm. Yeah, and it's big enough, that you no longer have to pay premiums into it. There's enough money in the policy; it's going to continue to pay the premiums themselves
All right, I want to
and
answer.
keep them growing.
I want to answer a couple questions in the chat here. So Warren is asking, what are the variations, if any, between the insurance companies offering IULs? There
The Moo IULE and the Americo.
Americo and even Forrester Smart UL, which is not an IUL. It's not tied to an index because they're participating whole life, so they have a universal life option. Michelle, I'll let you answer this, but I'm going to give it my best stab first. All of those express issue IULs from Moo IULE to Americo IUL to Forrester Smart UL, these are designed to be permanent death benefit policies that might grow cash value, but they're not designed to be intentionally overfunded in this way. So when you are thinking cash value IUL, we have one option, and that's with F&G. The
Exactly.
others, they're designed as permanent death benefit, as in the cash value they accumulate is offsetting premiums. So it keeps the
Exactly.
premiums low, which is why it's more affordable than whole life, but it's using the cash value to offset the premiums as you go rather than really build cash value. So there we have one standalone cash value IUL, and that's here.
You get a gold star. That is
Thank you.
exactly it. Yeah.
Thank you.
And I spent a lot of time when Moo IULE came out and Americo IUL came out, I was on the phone with their peoples like, help me understand this, because I just really wanted to, there were a lot of questions flurrying around and really dug into it. That is exactly it. It is a hybrid. The cash that thing accumulates is really intended to offset the cost of insurance as they get older, which is how it keeps the premiums low. If they take the cash, the policy will lapse. It will not last as long as projected.
Yep. Okay. So Simon, upon Jeff's passing, Michelle, I'm gonna let you take this one. His beneficiary will just receive the death benefit or the cash value.
You'd get the full thing. Whatever's left of the cash. See, it shows here on the third column is the net benefit, which is the face amount plus the account value. So they're going to get what's in column on the right minus any outstanding loans and interest. Interest does accrue. It's like 4%, which is presumably depending on based on historical performance, far less than the interest you're going to earn, the credits you're going to earn. So it would be this $740,000 minus any outstanding debts, loans, and interest.
Yep. So Simon, if you're looking at this illustration here, um, and you look at the age 66 or age 65, year 35 coming
Mm-hmm.
across, that net death benefit is 740,000 because it's the account value of 607 plus the death benefit. They're getting both the cash value and the death benefit. As this Jeff guy takes out money, he takes out $62,805 a year, year over year over year over year. That's a loan that has to be repaid. So going to let's say age 80, year 50, if Jeff had not touched or taken out any of that money, his family would be getting 1.67 million plus the 118,000 initial death benefit. They'd be sitting at about 1.8 million that they would be getting. Instead, at age 80, the family's only getting 372,000 because the rest of that 1.8 million is going to pay back the 62,000 that he took out year over year over year for 15 years.
Okay, congratulations, dude.
I
I'm so
learned I
proud of
learned
you. I'm
something. I
so proud of
actually
you.
learned that right here from you in this call. I did not know that before. Donovan, is this tied to the S&P? This is where Michele comes in as a subject matter expert. She gets to choose within F&G's formulation. She gets to choose the index to tie it to, and I'll let you go from there.
Yep. There are 9 index strategies. We use S&P, Barclays, Trailblazer, BlackRock, and Morgan Stanley. I follow the advice of F&G and the advanced market team, and it changes based on world events and market conditions. So at the end of your policy year, on your policy anniversary, you get a statement. We look at it. How did your index perform? Do we want to make a change? So based on whatever is happening in the world and the markets and all that, it used to be the instruction we were getting until about 4 months ago was a 50 was basically S&P and Barclays, and then they added this Morgan Stanley, and so now we're doing Morgan Stanley and BlackRock. So great question. There are options.
And I mean, full transparency, November was 1 year ago where Michele wrote one of these exact policies on my wife to set her up and we timed it so that we would start, or she would be able to start drawing money from that at the point my term policies expired. So if I die before 71, she gets my death benefit from my term policies. If I die after that, she's all set up with money coming in from her IUL every month.
And by the way, your account statement was mailed out yesterday. We'll talk soon.
Okay, cool. Thanks.
And to that point, it does. I don't know what I was going to say. There was something about when you get older. You don't. So the way the illustration is set up, I've got this set up that income starts at 66, but it doesn't have to, and it won't automatically start at 66 just because the illustration is that. That's just how we did this illustration, so you could see what it could look like if. You still have
Yes.
to call the insurance company. You still have to stop the payments. You have to start the income. So real quick, just for the sake of time, can we?
Roll to
I
the
think,
annuity.
yeah.
Yep.
Who's excited about annuity potentials? Who's heard all the great things about annuity and all the money you can make in annuity, and the guy in Alaska who didn't know he had $1.8 million?
I know nothing about annuities.
Well, let's look at one. So annuities, one big difference between an annuity and IUL, annuities need a lump sum. You can add additional monies to them depending on the annuity. Sometimes they'll allow it for 12 months, but they usually require a lump sum, like base minimum would be $10,000. But an annuity does not have a life insurance policy attached to it. It is a contract for future income, but it's through a life insurance policy, so it has some of those same IRS provisions in it. So this is still our same Jeff Sample, very creative there, 30-year-old guy. Now in this case, like a lot of people I know, Jeff, you've got that $75,000 401k from your prior employer, and you were worried that it's sitting there doing nothing, right? Because it's from your old job, you're worried about it. So we're going to put it, my recommendation is that we take that $75,000 and do a qualified transfer so there's no taxes due for moving the money. You know how they tell you to, if you move the money, you could have taxes, no taxes. We're going to move it into strategic growth annuity, which different annuities are structured to do different things, just like life insurance policies. Term versus whole, they have different functions. This one is really truly designed to grow. This is a phenomenal annuity for younger people who just want to put this money in and let it grow. It's kind of like bread. Put it in the corner, put a towel over it, and let that bread rise. That's what this annuity is going to do. So we're going to take Jeff's $75,000, and this one, same thing. It's an index credit, so your money contractually can never go down. Your gains and your principal are locked in. That is huge. That is absolutely a huge thing. This one we're looking at a UBS, United Bank of Scotland, but it's similar to the IUL in that you've got multiple index options, and we can review it every year or as they change. So we're going to just buzz over here. These are all the different index strategies. And if you guys want to see these, I'm happy to forward it and discuss it with you. So there's a couple different views. This one, instead of having the 3 columns of views, it does 3 different pages. So this is your guaranteed illustrated values, 0 growth throughout the life of the policy, which, if that happens, never happened in the history of the world. If it did, we're in trouble. This is based on the most recent 10-year historical performance. This is kind of like the baseline that we really look at. Now look at this. Your weighted annualized rate of growth, 18.07%. 18% growth. The annualized is like almost 17, 16.9. So if we took your money, Jeff, there's $75,000. We're going to split it. I won't go into all the detail of that, but we're going to put your money. So we're going to look here at column 6, the account value. In year one, this is slightly lower than your $75,000 because there's a fee related to this, but so you're sitting on, call it 74. That is your account value. Look at year 5. Come down here, year 5, you're at 166,000. So it's more than doubled in 5 years.
Wait, I only put in 75,000 one time?
Yep. Yep. So the annuities now, most of them, most often you put in a one-time contribution. You're not making monthly payments. You're not doing quarterly payments. It's a one-time lump sum. Some of them do allow you to add additional monies to it. This one allows you to add additional monies within the first 12 months. After that, it's pretty much locked in. And those minimum deposits must be at least $1,000.
Javier in the comments is asking if you can convert an old 401k to an annuity tax-free.
Yes, that's what this scenario is.
Okay.
We move it. There's a whole process we go through. It's called a qualified transfer. There's documentation you sign through the application, and you don't touch the money. The check is payable to the insurance company. They might mail it to you to turn around and mail to the insurance company, but I guide you through that. I work through all that. I call the custodian with the client, and we make sure that that's moved properly because we do not ever want it to be a taxable event.
Okay.
So that's what this scenario is. We took $75,000 from an old 401k. It has to be an old 401k. If you're still employed, if your client's still employed by that employer, I've never heard of any employer that would allow you to move the money.
Okay.
They're controlling that 401k. So, but look here, you're 30 years old. We put this money in here. In 10 years' time, now you're ripe old age of 40. You're sitting on 356. If you let this sit for 20 years, $1.7 million. And so you'd be 50 years old. You take this 1.7, this whole thing, this particular, remember guys, annuities are like insurance policies. Some of them have different features than others. This one is a Corvette. All it's designed to do is go fast. It's not comfortable. You're not going to pack up the kids. You're not going to pack a picnic and stuff, and you're certainly not going to tow anything, but it's going to go fast. This is designed to grow. If this was my client, we would put this in here, grow this baby to $75,000, and he's going to be sitting in 20 years on $1.7 million if it performs historically. I would take that at that point in time. We would move that money into a different annuity that provides a guaranteed lifetime income. Because now you've switched. Now you're not a young 30-year-old with all this time around. Now you're a 50-year-old and retirement is coming close. And we can move that money to a different annuity, let it grow, and in 10 years' time, it would mature and you could annuitize it. And whatever your account value is at that time, I don't know, call it $3 million. Then you can turn that into guaranteed lifetime income. And they'll say whatever your account value is at that time, there's some mathematical math that goes in. And the insurance company says, based on that account value, we guarantee we will pay you X per year for the rest of your life, whether you totally exhaust all the funds in the account or not. If you have a 401k, when the money's gone, the money's gone. If you have your money invested in an IRA at the bank, when the money's gone, the money's gone. The guaranteed lifetime is one of the biggest things for seniors, for people going into retirement, because they're terrified of outliving their retirement income.
Yeah, Jules in the comments is talking about a client I guess you guys worked with,
Yep.
Tamiko, not
Yep.
medically able to qualify for life insurance, 48 years old, but had a $72,000 IRA, and you were able to get him an annuity that had living benefits. So probably not this Corvette that was only designed to go fast. It was probably
this Corvette.
It is, and that
Because
this
he's
one
only
even comes.
48. So we're going to let it sit.
This one comes with living benefits.
Mm-hmm. It
Oh,
has, yeah, it has the living benefits. It doesn't have the guaranteed income. He had a choice. We talked to him about it. He was worried about being able to pay off his mortgage. He's got two kids, single dad. So yeah, we put him in this. It's going to grow, and he's super excited about it. That was one of the things I wanted to mention. So the annuity benefits are, it's tax deferred. When you take the money out of this, it will be taxable income. But it's growing. You're getting all of the market like growth. I mean, look at this, guys. There are years it grew, the index credit was 33%, 31%. It varies, but year over year, an average of 16%. It is huge market like growth. But on those few years when the market goes down, you don't lose a dime.
yeah.
And that's huge. So you
So,
have that, you have tax deferred, and there's no medical questions. So your people don't have to medically qualify. There's a
so
suitability requirement, but
I'm gonna bring Jules. I'm gonna bring you up here in a second to chat about that experience. But uh, on everybody's mind, because we have this now, you guys are watching all this, and your brain's spinning like, man, there's a lot here, and you got to know these indexes, and you got to know this. This is why Michele knows it, because all you have to do in HQ is learn this about your client and schedule it with Michele. Then she does everything. And there's a built-in commission split. So, assuming Amber knows Jeff, and she knows Jeff has this 401k sitting there from an old job, it's sitting at 75k. She knows Jeff. She sets up an FIF reset with you. You take it home, you introduce this, and Jeff is thrilled. He goes through and does it. We'll get to the scheduling in a second. But what does Amber make just for referring Jeff to you on this?
40% of the commission.
So give me that number.
Commission. So if it's an annuity, your APV is 5% of what was put into it. So if it's $100,000, APV is $5,000.
Let's roll this exact Jeff thing. So it's $75,000. You said 5%?
5%.
So that's 3,750 bucks.
She would have made $1,500.
1,500 bucks just for the referral. She didn't need to know it. She didn't need to illustrate it. She didn't need to sell it. She didn't need to do nothing other than exactly what Michele's demonstrating on the screen now. Go to HQ, go to sales tools, go to FIF and resets.
Mm-hmm. And then this first box. The other thing too, Jim, and there's a handful of people on this call that have done this. What if Amber had her own old 401k
Yep.
sitting at Fidelity or Principal or wherever doing nothing? You can transfer, we can do this with your own 401k and you get paid on the commission.
Yeah, you get paid your own commission on your own referral, referring yourself.
Yep. So you just go to FIF reset. And guys, so if you look up your client here, I always pull up this young lady because I know her well. This was one of my clients. So you just pull up your client, pulls up all of their information. You don't have to put all this stuff in here. Come down to the bottom, give me some information and click easy reset. It's going to say what do you think? Do you think they're a debt-free life or annuity or a IUL, whatever it is you think they are? I don't know why I'd ask this question, but it does. Do you think a market correction would affect your retirement? Of course. And then you say continue, and then you just click my calendar here and you can book it.
Yep. Awesome. Julie, Chesnowski, are you in a place where you can come on camera?
Sorry, can you see me?
Yep.
Michele, can you stop sharing your screen?
I can. I can see Jules.
I wasn't prepared.
No, I know. I put you on the spot. I just liked your comments in the thing. So you referred a client to Michele in the scenario you gave, medically ineligible for life insurance. Can you and this was a lead. So can you walk us through from buying the lead, calling the lead, to what questions did you ask that triggered that ultimately led to Michele? Give us your experience with this lead.
Yeah, so this was my second actual reset, but that actually has gone somewhere so far. So basically we had a normal, I don't know, conversation. The client was very easy to talk to. So, we went through the questions and asking, the qualification questions and what he was looking for. And he explained he had a mortgage and, two kids, and he was a single dad. So he was really he had multiple sclerosis. That way he was diagnosed at age 27, I think. So he actually wasn't disabled yet. His doctor predicted that it would happen much sooner. So he was just looking ahead and wanting to be able to, protect the kids, the mortgage, if something were, if he were to basically not be able to work anymore. So he was essentially looking for a policy with like living benefits. And I explored everything and I'm like, he's just not going to qualify. A whole life plan wasn't going to solve his problem. So I just dug in deeper and I asked him if he had any old 401ks. I was still pretty new at it. And he was like, well, I did work for Prime America when I was 19 and they convinced me to start an IRA. And so I'm like, okay, how much do you have in that? And I think he thought it was like 50,000 at first. And then
he was so far off.
Yeah, so he was really off. So okay, we did and then I got Michele on the phone and we did the, I did the FIF form in HQ and everything and set up a call and she did illustrations based on that amount. And then a couple weeks later, I think we had another call set, but he texted me and he was like, I don't know. He was like, I only have 20,000 in the IRA. And so we were like all super bummed. But then
we had a pivot. We had a different plan.
Yeah, I can't even remember. He was really bummed. And then it turned out that he called them and he had the money in two different accounts. And there was actually more than he thought. So we had a good relationship with him. So it was just easy to, he was very easy to work with. He was very appreciative. So, it was just digging in. And I think Michele and I both agree that we're so excited to be able to help him. And he was so grateful because he never would have known that if I didn't ask questions. So
Julie asked a lot of really good questions. She kept digging because she was so desperate for his sake to find some coverage for him.
Yeah, I felt like so bad.
And he truly forgot about this. He opened this account when he was 19, $50 a month, out of sight, out of mind. It was just happening. And he had no idea how much money was in there, or even until she really started digging in, he'd forgotten he had it.
Yep.
Yeah.
Anyway, we are up against time. No, you're good. That's great. Thank you, Julie. I wanted to share that experience, guys, because you've got a lot of people that need our help that you're talking to already every day that can help, whether it's your friends, your family, yourself, your leads. There are things we can do to help that are awesome. And I wanted you guys to see in real terms, in real life, what that really looked like. So Michele, thank you for your time. Thank you for the policy you wrote for us. Thank you for your service to our agency. We super appreciate it. All right. Got to roll. We're already a few minutes late. Have a good one, everybody. I will put this up on YouTube tomorrow and we'll talk soon. Bye, y'all.
And let me know if you have any questions.
Yay.
Bye, guys. Thanks.